Ding-a-ling-a-ling-a-ling-a-ling. If you're on Discord, use the just chatting, but actually I prefer if you use the either TradingView chat or the YouTube chat so that I can but there's a lot of people in here, so yeah. All right, I'll try watching both at the same time. Jen, give me a thumbs up. Are we both lag behind Discord? Yeah, I actually changed the latency on the YouTube so that maybe we won't have a total lag out on it. All right, let me start in just a minute where people filter in, and we'll get started. I'm going to get myself a drink of water. Be right back. Hey, everybody. All right. Hey, we got a good turnout in Discord right now. GG Zygor. Okay, looks like we're doing pretty good. We are watching ExxonMobil, and man, what a rise it has had. And a lot of that's off of oil. I'm actually going to talk about ExxonMobil a little bit later. I did a spreadsheet actually because I wanted to present a post-mortem, even though this trade is actually still on. I still have a few more, about half my contracts left in ExxonMobil. Put them on back in December, actually. I talked about it a few days into the trade back then, but I really want to dig into the trade and show you guys what is possible with long-term options. And by that, I don't mean leaps. I don't mean out to January of 2023, just taking a few months worth of options. And you need to mute yourself. You have permission to talk. So.
Oh, my bad, dude.
Yeah.
I'm putting my bag away.
All right, I'm going to mute you because I don't. You can probably unmute yourself. Okay. So I want to talk about that, but we got to talk about cryptocurrency first. Got to talk about the stock market first. Very interesting day today. It was a very leptocurative. Oh man, what is that? What is that word? No, actually, now I want you to speak. I want you to tell me what is that word?
Leptocurtic.
Leptocuric. Yes. Can you tell me what the definition of that is?
Leptocurtic. It means that something has greater than normal kurtosis or greater than normal distribution. So, like an excessive wave in volatility, basically.
I'm
Like
a
bigger
fifth
swings.
grader. What does it mean?
It means shit's volatile. Basically, more volatile than usual.
Okay. See, actually, hold on.
But more prone to excessive swings, not just like big swings, but excessive, like overcorrective swings.
Okay, so
is the implication.
So when I looked this up, you posted a few days ago, and I'm trying to learn this because it's a good word. Maybe we can come up with a meme to talk about it. But leptocurtic, having greater kurtosis than the normal distribution, more concentrated about the mean. Yeah, I need a translation of that. So so your basic definition of it is that it has very volatile overcorrections around the mean, basically, right?
Yeah. So the thought process behind the leptocurtic market is that the excessive gamma buildup from all this put and call buying in a more narrow ranging market like we've had is causing larger swings around the mean or around valued areas.
And I think that would basically describe both the ES and the Nasdaq today. Ooh, look at that close.
Yeah. And it's also of one more thought is also of note because the VIX has been relatively suppressed, but we've had bigger swings than the VIX would tell us we were going to have on a day-to-day basis. Like we shouldn't be getting these big swings historically based on the level of the VIX.
I know it's not really that elevated, is it? So, all right, but we're going to talk about that. So, let's get into it. Let's do the top because I know a lot of people watch this for crypto. Obligatory start with the crypto markets. Bitcoin bearish. Ethereum bearish. Monero actually kind of interesting. It's kind of neutral, but I think a lot of people this week when we had this bounce, and this is a significant bounce right here. So here's our liquidation low back in December that I've been watching for, like a force of gravity. Prices pulled down to it. This price action right here, it's basically, you could call that a false breakout. It tried to break lower, but it didn't, and so it held. And then what it did was it came up to the level I marked off, which was nothing fancy. It's just the Ichimoku levels. The first level of resistance here will be the Tinkinson on the daily, which is the 50% of this move down right here. And it could be doing a little pop to hold it here, but these 1%, 2% days on crypto are not what people are used to. Hey, what's up, MJ? I went to a Bitcoin birthday party last night. We have a cookout. We've been doing this since 2013 with guys local in Atlanta. And one of our most bullish Bitcoin advocates was a little disheartened, actually, which I was kind of surprised because he one time a few months ago said, I think when we were in the rise up, that if you really understand Bitcoin, let's just clean this up a little bit. I think somewhere right in here when we're in this rise and people were scared to get in, if you really understand Bitcoin, you know that it is a risk-free proposition. And the reason for that is because they're only making so many of them. And this kind of parlays into what I said in my little talk, where I said, all these kids that are getting into cryptocurrency right now, they're getting into these NFTs and they're getting filthy rich off pictures of apes and all that kind of thing. Well, what we need to do to advocate for Bitcoin is we need to tell these kids Bitcoin's kind of like an NFT in that you can own it, it can be yours, except it's better than an NFT. It's actually an FT. It's actually fungible. And you can break it off into smaller parts and maybe exchange it for goods and services. Whereas if someone's going to want to give you a sandwich for your picture of an ape at some point in the future, that's a little bit more of a dubious proposition. So Bitcoin is the ultimate NFT. Hashtag that. So that was my message to people last night. Yeah, there's a lot of people stealing NFTs out there. Right click, save as. I don't know. I don't know if the law is going to come after them or not. I don't know what the penalty for that is. Anyway, overall though, cryptocurrency it's still there. The sentiment has not changed. It hit a resistance this week, a short-term resistance there at 44K. Really, it's just my gut. Last week, what was it, the 10th? No, it was Monday. Monday, I saw on the swing trading time frame, yeah, it was the 4-hour right here. Right here at this false breakout, it triggered a spike. And you guys know, if you watch my stuff, this is what I key a lot of stuff off of. There's trades today that I took based on it. This trade, as it were, this spike trade on the 4-hour or the 2-hour, depending on where you put it, this is still live. In other words, it has not stopped out. The stop of this trade is about 39. Let's call it 39,500. And the target for it would be to get back up to this price action range right here. And so while I'm not a perma bear, but while I'm bearish on sentiment, I'm still going to call out potential bullish trades, some red meat for the people that want to be long. This right here is still active. So as long as this thing's active in the short term, going into this weekend, as we have for most of the week here, this is bullish. Okay. And believe it or not, if we're going to do a little more granular price action analysis for the reversal, this move up we have from Monday until basically, I think last night, it also held this 50% retrace right here. This is a good hold right here. Now, what's going to happen in the future, who knows? But right now, going into this weekend, I can see Bitcoin going up. So that would be my analysis in the short term. But profits, if you're trading it because you're in a bearish trend, it's a really good idea to take profits. It is. So that would be my assessment of crypto coming in. So I think we got enough people in here. If you have questions, if you have something for me to look at, you can get my opinion. It may not be always predictive of the future, but I will analyze stuff for you. Trading View chat. I've got Discord up, and make sure this on the screen, and YouTube actually. So put some symbols. Tell me hello. I really want to talk today. This week, not nearly as interesting as last week, but I got some stuff to talk about. But I want to talk about what you guys want to talk about. So bring it up to me. All right. So let's now look at the market indexes, because this I thought was very interesting. I will look at Adobe. Well, since I need to, let's see what it closed today. Adobe was a trade I put on today. I really don't want to be long tech, but I got to be long something tech. It could be bottoming out. Yeah. So this was a spike on Wednesday. Okay. So this was a short trade on Wednesday that came up. I noted in Discord for anyone that wanted to, possibly take it, but I have a superstition, which is based in statistics, that I don't take trades on Wednesdays. And when I don't listen to that, they tend to be more losers. Now, actually, I think, the last time I looked, my statistic on Wednesday trades I take on Wednesday, swing trades I take on Wednesday, was something like 18% win rate. That sucks. So if I just don't take trades on Wednesdays, my performance improves. And I hope it's not the same for you. I hope Wednesdays are your best day. But, I explained this to somebody, and they talked about maybe something about the lull in the week, it's midweek, hump day, whatever. The best days are Tuesdays. Wait, what was it? No, the best days for me to take trades statistically, the best of the best was Tuesday. The next best was Monday, Thursday, Friday, Wednesday, in that order. So Tuesdays and Mondays are actually pretty good for swing traders. But that makes sense. It's the beginning of the week. Anyway, this was a trade on Wednesday, a short trade. Now, I like this as a short trade because, as you see here, it was at a 50% retracement level. And so this kind of had me, from this high up here from December 27th. Okay. So this had me interested here at this level. This is a damn good trade. It's just a Wednesday, didn't want to take it. So if you had taken it, then you would have shorted it right here at the Tinkinson. Stop would have been right above it. Notice how it pinged the 50% retracement right here. I like that. And then the 3-to-1 would have been all the way down to here. And actually, yes, it would have actually pegged the 3-to-1. That would have been a good trade. But this morning, it gave a bullish spike right here, which was, again, from the rally, the 10th, from the beginning of the week up to Wednesday here. And this bar closed above that 50%. Boom. And so closed above it, closed positive. The entry was down here off the red line. We'll see how it goes into next week. This is my tech buy forward to see if we get some kind of resurgence in tech. I hope so, for everybody's sake. Man, it's kind of sad to look at things like Etsy, which were big winners last year. Man, so I was scaling out of this position of like my long-term portfolio position. I'm still bag holding some, but not nearly as much. And that's what this is one of the reasons that I implemented a portfolio sizing for long-term holds. So I'm going to take a swing trade, I'm going to take profit, most of it, and then I'm going to scale out, keep it under about 4 or 5% of my portfolio. So yeah, but I was looking at this, and right here at the beginning of the year, this is what to watch for. Let's actually overlay Ichimoku on this, like when these things were done. And as you know, one of the key principles of Ichimoku is looking for that momentum, the lagging span, or Chikao. I'm going to start calling it Chikao because I'm a purist with Ichimoku. On this day right here, on the 4th of January, when momentum got out, let's just see what it looked like then, just so you guys can put it in your heads. Yeah, when this actually, was it this day? Yeah, actually on the 3rd of January, which was at a Friday. No, that was actually the first day of the year. So on the first day of the year, you probably might want to have held it for this range right here, but still. There's that. There's Ichimoku breaking down. But also, if you just draw the 50% of the whole move from back in May of 21, notice what it did. You got down to it, bounced off of it, and then here it held as resistance to go down. And so this is one of those things where I say it to remind myself, it sucks taking losses. It sucks cutting losers. But when you see things telling you that you no longer need to hold on to something, there's no reason that you should hold on to it and just hope that it comes back, because things like this can happen. So from the person that didn't take this opportunity, they'd be down 30% on their position. And the person I'm talking about myself here, because I basically was just relying on portfolio sizing to keep this relative to it. I'm still bag holding. Like my entry was back here in May. So I'm basically on my long-term hold position, holding it at this range right here. So it's basically back at break even. But being able to take it off here, or when it breaks out of the cloud, is less 20%. And you just don't need to take that kind of a loss, Wes. So yeah, not too happy about that. But as we were talking about in the chat today, you needed this. Tech got way too frothy. I mean, it's just it got a very big bump in the end of 2021. Everyone thought that tech was going to roll over sometime mid 2021, but we got that last leg, which of course everything's going to be led by our friends Apple. And where's that 3 trillion mark? Yeah, it basically hit its 3 trillion mark. It just bounced off of it. Now, Apple here, and I am going to talk about, hey, what's up, Falco? I am going to talk about the Nasdaq, but stream of consciousness, Apple. This right here, I noticed this week. That is a very interesting hold there off of that level. So it's getting into a pullback territory. I really, if I had to speculate on this, it's going to pull back to the cloud at this point on Apple. From here down to, we'd measure, because Ichimoku's not really giving us a proper, yeah. So I'd basically say Apple could be undergoing a pullback to about 160 if we are seeing it that way. Now, I may keep on going. This is what I see a lot when you do this kind of a crossover here with the Tinkas and Kajinsen on Ichimoku. Basically, most of the time, the trend is going to be contained by the Kijinsen, the green line here, which is the 26 period. Occasionally, you violate it, the red line, which is the Tinkinson, but that's the sound of a strong trend. So now, though, it looks like it's going to do a pullback to here. So you have an alert down there? Yeah. Okay. So Nasdaq, this was interesting. And since December, Nasdaq has really been the thing to watch. It's really kind of, well, Apple's very prominent in it, but the price action has been very interesting in Nasdaq to me as opposed to the ES. And it got really, really close today. This is the Nasdaq futures we're looking at. This is the daily using Ichimoku. Remember how I talk about how when momentum gets outside of the cloud, then you have a bearish trend? Well, it's trying, but it held this level right here, which if we jump up, this is the weekly Kijinsen, which, as I was saying in the Apple example, sometimes you come down and you test that Kijinsen, and these are all key levels to define the trend. But once you break below it, what you might end up having is like a pullback and then a pullback into the cloud like that. That's sort of general Ichimoku price action that I have looked for over the many years. Maybe one of these days I'll do like a full module on it. But for right now, just to keep things simple, this week we held the level. So, and the price action today, I really wish that we could do a backtrack, or excuse me, a replay on futures, but unfortunately with TradingView we cannot. This was really the kind of the move for today. So let me bring it all together, because this was my trade from this morning that we did in our index trading. Everything just kind of lined up, and here's why. So this morning, I've set myself to getting up at 8 o'clock because a lot of stuff begins at 8 a.m. in the stock market, and on some days you'll have a 8:30 news event that happens. So you want to be in front of the screen for that. So when you had the market bottom out, here's my thought process. You had this bottom here right at 8 a.m. Again, these 30-minute increments, like 8 a.m., 8:30, 9, 9:30 especially, watch for them. If you're in a trade, if you're trading futures, your 30-minute rollovers into the next bar, the next time period, it's not every time, but very often you see some kind of inflection or major change right at that switch over. Ant and I, we've been noticing it, but one of the things I've always noticed for years and years is that 11:30 cutoff. That's when Europe, the European markets, London goes offline. I think the FTSE stops trading, and things can really reverse at that point. But anyway, 8 o'clock was where the market bottomed. So just keep that in mind. And then, through the rest of the minutes it is. But here we come around the 8:30. There you go. And then right here at 9 a.m., I noticed that there was a higher low. Okay. I don't trade based on that. But what I do look for is Ichimoku to get back outside the cloud right here when the momentum was out. Now we're bullish. This is on a 1 minute, by the way. And then what I wanted to see was, again, a 50% retracement. And at the point that it pulled back here, when I already knew that I was bullish, boom, buy it here and then take it up. Now, I'm not going to sit here and tell you I took it for all this. I closed it out right around here because I take profit too early in just about everything. But there were some other good opportunities here, And the main thing that it started flirting around with was this level right here. But they just played games. But this was the trade of the day. And again, notice the 30-minute increment blocks, like 8 a.m. bottom, 8:30 pullback, 9 a.m. higher low, and then right at 9:30, the market open to the moon. So if you're trading the indexes, watch for those 30-minute switches because things can happen, things can switch and flip at those points. So hopefully that was some useful info for you guys trading those indexes and stuff like that. Any questions on it? Put your questions in the chat if you have it. I want to talk to you guys today. I got two more topics to talk about: sector rotation and then the XOM option, and that should be today. Question from F10. Do you think Tesla is forming a head and shoulders? Do you see a downside? Well, I always see a downside to that question, but yeah, let's look at Tesla. I am actually long Tesla, and I'm a little sad because the year opened up the first day of the year up to this point, and actually, Miss Vic Steen asked me, "Hey, what's your target?" And if you recall, I replied, "Well, on a price level now." But I want to hold it to see if it gets up to the top. What you saw there was me being a little too greedy. This was me not taking profit. Because now look where you are. Are we in the head and shoulders? So a head and shoulders, I hate to do it, but here you go. A head and shoulders is more what I think is going on in Bitcoin. Let me explain. Let's clean this up. So a head and shoulders that Bitcoin did, we'll start there, is more what it did back in April of 2021. Okay, head and shoulders is it's you have a shoulder, and a head. So you've got three highs that are going to define the head and shoulders. It's a classic pattern. Okay, so you'd have a left shoulder, the head. Oh, I'll tell you what. Let's not try to draw. Let's do this. Where's my? There we go. So here's the head. And then let's try drawing in trading view here. So this is Mr. Stick Figure. And then here is his arm. So here's his shoulder. He's got a shoulder pad on. And there you go. So there is Mr. Head and Shoulders. All right. See? Okay. So what I think is happening now in Bitcoin on the weekly is something to that effect, where instead of being Mr. Head and Shoulders over here, now this could potentially be the head, and this is going to be the shoulder. At some point in the unforeseen future, and at some point at the unforeseen price, what I expect is there to be yeah, he's got really long arms, Mr. Head and Shoulders there. So that's what I kind of expect there. So to your question about Tesla, short answer, no, simply because this guy, he's got his shoulders over his head. So no, I don't see that higher high here in the middle. I don't. It's actually lower than this one right here. So what you have in Tesla is just a nasty consolidation pattern that pisses people off that bought it around 900. So that's what I see in Tesla right now. I do not see a head and shoulders. I just see a bullish trend stalling out, and it may come a time where I have to cut it. I'm not opposed to it. I don't care. Talking about cutting stuff that people have been want to stay long in. I cut when ARK broke. I cut it. Done. And I don't care. This is how much money I saved in my account by not trying to bag hold ARK. So Tesla, I want to own it, but I'm a trader first, and I'm going to manage my risk. And if it starts to get, if it really starts to mess around here, or even especially if it breaks into this area right now, it could spike down. It could fool me out. I don't care. These things can happen. I mean, I was looking at this with. Now I want you guys to take a look at Apple historically. I think it really. I think anyone that's trading now, if you just started in the last year, or if you just started at any point recently, and you haven't really taken stock, you haven't read a history book about what price can happen. Apple, they've got tons of cash. They're a great company, pay a great dividend. Everyone has an iPhone, blah blah blah. Yes, it's a good company, but you know what? It's also a company that, and I'm not talking about in COVID. This company, back in 2018, during that little fall thing that I talked about last live stream, it came down 39, almost 40% off its high. This is Apple. This is the great company of Apple. Now, yeah, of course, from now it's it's many multiples of that. But if you were sitting in Apple, I mean, that would have probably bugged you a little bit. I mean, what about the Fed's taper tantrum, which was what the 2018 narrative was? What does that have to do with how many iPhones people buy? Well, it doesn't. But you still would have seen that much of a drawdown. And then back in 2012, back in the before times, way in the BC before Corona, again, another 44% down move. And then, of course, in 2008, as we can expect, from the high down to low, it was a good 58%. So these tech stocks, I've been trying to tell people, even as they've been really excited to get into them, you got to pay for these gains. The reason you get such outsized gains is because of volatility, and it goes both ways. It goes both ways to the downside. So you got to be wary of it. I'm not saying that Apple's going to go through a 30% correction. I don't want that to happen. I'm just saying you got to appreciate that it can. And Tesla. So to answer your final question, do you see a downside? Yes, I definitely see a downside. I see a downside in any of these stocks that doubled over the last year or two, of coming back 30 to 50%. It's entirely possible, because that's what you get when you have those kind of gains. It works both ways. That's the market. That's what you've chosen to play with. Learn it now, or face the consequences. The question is, can you explain what people should look for first before trading a reversal? Did you catch what I was talking about with the Nasdaq earlier? That'd be my question to that, because that's a very broad question. What I use that I've talked about, we were looking at what is it, Adobe. It's a good example for today. So in case you weren't here for that one, so I have an indicator that I use, spike alert, which people that have been watching I've given away free. But I have an announcement to make. I actually have an announcement. I'm doing a pivot, and that pivot is a lot more people are asking me for personal attention and help, and that's taking my time. And I love doing it. I love helping people, but it is my time, and so I am actually going to discontinue freemium services for everyone that's not already in. Everyone that's in, I'm still going to appreciate the support that they give me. So if you want this indicator, this is the last live stream. After this, you can ask me for it, but the spike indicator is going to go private. Not saying what I've attributed cost to it yet or not, but I'm announcing it now. So anyway, I use this for one of my examples. The other, as I was talking about, I look for what I call a reaction level. You have a low that's made, and then a trend off of that low. I look for a 50% retracement, and boom, there I have my confirmation. I am definitely not a falling knife buyer. I don't have a knife in my I have a spoon. I don't buy that falling knife. And what I see as a falling knife is the example I had with ARK. You just don't know where something like this is going to stop. You had this reversal here on ARK. This is what I played. I looked for this as a potential reversal, and it broke below that, and I'm out. So I always want to see some kind of, for reversal, I want to see some kind of an up move. Or in the case of a top, I want to see some kind of down move. I want to see some kind of price action that tells me that buyers are coming in. And rather than just think that, I'm going to use technical analysis to tell me what that is. And that what that's going to be represented in is these kind of short-term price movements where it spikes down, gets everybody out, and then comes back up to close back within the range. That's a sign for me. And then also I'm going to measure that short-term trend as well. Let's go through the things. Yeah. Let's see. I got to go. Oh, I got some stuff to talk about. All right, let's go through some of the questions before I can get to my topics for today. CHPT. CHPT. Okay. You went long today. Spike on the 10-minute for bonus. So did you go on the 10-minute or did you just get a 10-minute later and now you're using the reverse justify? I mean, okay. Again, falling spoon. Good luck. Yeah, Facebook is the new Phillip Morris. For those that have been maybe following me for a long time, I am very bullish on Phillip Morris because I don't smoke cigarettes, but I know people that do, and they sure as hell aren't quitting. And it pays a very good dividend yield. And so my thesis on, I mean, I don't care what I care, but with Phillip Morris, 7.28% dividend yield. Where can you get 7.28% return on your money? In a savings account? No. In a bond? No. I mean, you get it by taking the risk that you have a drawdown here, like we had in the last quarter of Phillip Morris, but with these consumer staples coming back, consumer staples have been since December rocking, and Phillip Morris is part of that. And the joke today was that Facebook is the new Phillip Morris because people are addicted to it, but they don't pay a dividend. They don't pay a dividend. Okay, CIM. What's CIM? Chimera, excuse me, investments. Okay, what do you want to do with this? Oof. I just don't. The problem here I see is trying to find what's the trend. I would start it back here because you had this consolidation. This was really where the launch point would have been back in October 2020. So you had it up here, didn't quite stop there, had it up here. So this is actually the broad trend. So yeah, I'd say 12 and a half. I look at 12 and a half. This, I just can't really see this as anything more than volatility right here. What was it, dividends or something? I don't know. So, Dog the Cat. How can I improve my conviction in trading? Price volatility is a killer. Have a system. Have a system. It can be really simple. I had this conversation with someone last night, actually. They were talking to me about fundamental analysis. And it's a kind of, this year I've been trying to be nicer to people that do fundamental analysis, people that believe in a company. When you do your research on a company, when you look at their product line, when you have a say, let's just say, use Tesla as an example. Let's have this up while I'm chatting about it. So let's look at Tesla 2018. So when you have a fundamental thesis on a company or a cryptocurrency or anything of that sort, when you don't look at price, because a lot of fundamental analysis people, they don't look at price. They think it's astrology for guys. There's no cool story. I mean, you can believe that, but if you apply it consistently with a probabilistic approach, it will work. But I'll get to that in a second. Fundamentally, people will like a company like Tesla back in 2018 because they see it as more than a car company. They see it as an AI company. Whatever the story is, allows them to sit there and hold onto it with diamond hands, the company, for the company, through a big drawdown. I think the drawdown here from maybe the middle of this range was, it was about 45%, about 40%. So if you bought it here, if you bought Tesla in, it's split, so the price is different. But if you bought it in this range at any point in 2018, you would have at one point mid 2019 been down half your money. That sucks. But you really, in order to not puke it, puke your position, sell it, you would have had to really believe in Elon Musk. And so the people that really believed in Elon Musk, well, they disregarded the price. They held to their conviction. They didn't care about volatility. They just believed in the product, and they were rewarded. So one way that you can have conviction is doing your research and having a fundamental view. And I'm not going to knock that. The other, which I use, is having a technical view. And what that lets me do is be, I wouldn't say immune to the price and volatility, but it tells me when I need to get in and get out. And then if I take enough of these trades in a series, I'm going to have a probabilistic outcome. Now, in the moment, if I have to close a loss, I'm going to be a little pissed. I do get a little emotional about it. But I know that over enough of these instances, it's going to work out. It's kind of like insurance. Like, why do insurance companies, when they have to pay out huge settlements, how do they stay in business? Well, it's because they have a system. Why do casinos stay in business when they have these huge things? They have a system. They have an expectancy that happens over enough timelines. And so how you can hold your conviction is just recognize that today is a day, tomorrow will be another day the market's open, and you're in it for the long game. And the part of that is not letting any one trade take your account down more than 30% and make it where you can't trade futures anymore. Yeah, we're not going to do that. See, once you do that, once you put all your chips on the table and you lose them, you can't play anymore. You can't do that. Even if you've got a small account, keep your losses small. Just try it. It's really good practice. It's really good practice, man, dude. You're killing me. Like, the point of, okay, can I use you an example? Or can I rail on you for a second? Yeah, okay. So, dude, man, one of my, esteemed colleagues, one of my highest level mods on the Discord, he decided to get into futures trading, which is good. I like futures trading, as you saw on the Nasdaq today. But he did it smart. He had a small account, about what, $2,000, and that let him trade the mini, or excuse me, not the E-mini S&P futures, but the micros. And the micros are they're basically an order of magnitude less, which means that instead of 1 point in the ES being $50, 1 point in the /MES. Let's just bring it up here. So the ES is /ES. You can bring up a trading view, or so the ES, which also, by the way, held its support. Notice that little 50% hold right there. That is a weekly bar. This week held the support, guys. Anyway, 1 point in the ES is $50. So from the close today down to the bottom, which Jen, by closing his position, marked for us, he basically sold the bottom because he got to his puking point. And I get that. I mean, you get to a certain point where you just can't hold a position anymore, and you gotta cut it. That tends to be the reversal. It's not because the market's looking for you, it's because you are the market. And there's a bunch of people probably like yourself that did stupid things and won stupid prizes. So that is 358 points, 358 times 50. So that's basically in the E-mini for this week from the bottom up to here is 17 grand on a single contract. No. I don't know what that 358 is. Sorry. It's 89 points. Sorry. 89.5 times 50. Okay. It's $4,475, $4,400. Let's call it $4,500. That is the range if you had a single contract of ES, whereas the MES, the micro, not the mini, but the micro, that is only $5. So that would have been $450. So if you have a smaller account, the margin requirements are smaller. And the purpose is that you can cut your teeth, you can learn with much less risk on these. Now that works great as long as you don't leave something on overnight where you take a big boy loss. There's no reason for you to take a mini loss on micro futures. Anyway, we're going to learn from that. We're not going to do that again. All right. Yes, insurance companies stay in business because they have actuaries who do magic for them. I need to start doing this through some software so I can have effects. I can do like magic, like glitter and stuff like that. Maybe later. All right. We're getting towards, not in the end yet, but I want to talk some stuff. So let's talk. Hey, thank you for the 500 coins, which I don't know what I can buy with that, but I'm richer. Thank you, MJ. All right. So let's talk sector rotation. Sector rotation. Now, this has been one of my more popular videos over the last year. People like to talk about this because it sort of gives a little bit of a window into the future of the stock market as well as the economy and the business cycle. So it took me a while to get this. I'm going to go through it really quick as a review. So this is the sector rotation model. Okay, you have these lines that go up and down. I'm going to explain what they are. So the orange line right here is supposed to be theoretical. It's all theoretical. Okay, this is the stock market. Hold on, let me drink water. And so at the point here at a market bottom, like the market, you had a crash, you had a bear market. At the bottom, what sectors should outperform the rest of the market. Now, this could also mean that they go down less, but they basically are just relatively better performing than the market overall. What should lead you out of those events is technology and consumer discretionary, luxury goods, things people buy because they want to, not because they need to. Then, as the recovery continues, the stock market goes up from the bottoms, communication services, industrials. Then, as you start to kind of approach the top, materials, that can be commodities, things such as that. Energy, theoretically, and this has happened a lot, things like oil begin to top out, have a lot of really good performance around market tops because oil and energy as a whole is forward looking. If there's going to be a strong economy, you need to go ahead and buy your oil barrels ahead of time so that you have enough to produce the energy needed for that strong economy. So typically, energy stocks lead at the market top. And then as the market begins to roll over, you start to see leadership in consumer staples, healthcare, utilities. more defensive plays, because consumer staples are things that people buy no matter what. Recession-proof industries, things like Procter and Gamble toothpaste, Phillip Morris cigarettes, McDonald's fast food, things like that. And these companies are pretty well established. They're value companies, and they pay dividends. And so people start to roll into these. So what has happened in the last few weeks? Well, if we break it down, these are the last 65 days going back to October. Let's go back a little bit further. Let's encompass that whole quarter. Say, is it 74 days? Not really going to matter that much, but let's see. Okay, so 30th September till today. Clearly, because I want to talk about it here in a second towards the end, ExxonMobil, that's been the big winner. ConocoPhillips, energy companies have been leading. And so naturally, there's a outperformance of energy companies here. Also, the closer and closer we get to this year, consumer staples, let's do 30 days. Consumer staples have also been leading as well. That's where your energy, ExxonMobil has been a big winner here. These are weekly bars, by the way. This is the weekly on it. Let's bring up the daily so we can see. Yeah, it's a big run here. ConocoPhillips, boom, and stocks like Procter and Gamble have been leading since December. McDonald's, if I recall correctly, it's been selling off here, but towards the end, consumer staples started leading. And then what's another consumer staple that has been a big winner? Yeah, our big favorite Kroger, mine and Jen's favorite Kroger. So yeah, these have been doing exceptionally well. Kroger, by the way, this is one I might have posted about a few weeks ago. Yeah, it did not fail its breakout. It made a new high and held it. I talk all the time about watching for failed breakouts. This is not. This right here, even though it came back to close below, now this week, let's look at the weekly to kind of clean things up. The weekly, this is so key. Such a great example here. I know I'm getting distracted from my sector rotation, but I love looking at these things. Thank you, Mahan, for the 500. This weekly high, this weekly bar closed above it. That's not a failure. That's a confirmation. And then this week was higher. Very simple. Look for that. Anyway, back to the sector rotation. So again, I'm not saying the market's going to crash. I always have to preface that because I'm not trying to bring about FUD and things like that. But energy is leading. Energy is decidedly leading, and so are consumer staples. Now, is it the tail wagging the dog? Are people buying consumer staples because they think that the market is going to roll over? Possibly. And the reason I say that is because if we go back to let's go back to the beginning of 2021. You may not remember, but Pepperidge Farm remembers. Energy was also leading at the beginning of 2021. And so one could have gone in and said, "Oh no, energy's leading. The market's going to crash." Back in, the first quarter of 2021. But as we know now in hindsight, 2021 was a record year. Every single month made a new all-time high. So, the sector rotation model, will it work this year? A couple of things that were different. Technology was still leading. Remember, it leads that bomb. So I really, throughout 2021, I couldn't get a good read on the sector rotation model because tech was just so dominant. But now, starting to fall off a little bit more, starting to really kind of rotate over. And what that suggests to me, what I'm going to be looking for is opportunities in, what is it, XLV. So XLV is the healthcare ETF. Now, I'm not going to be buying the healthcare ETF by itself, But what really brought this down, what really brought healthcare down, was Humana. Humana had a 20% dip on was it the beginning of January? No, it was early. It was not quite. Okay, yeah, it was January the 6th. That basically tanked all of healthcare. And the one that I actually have as my single stock is United Healthcare. But if the sector rotation model holds true, this could actually be an opportunity. So I'm not going out of my way to just go ahead and buy healthcare stocks, but if they come up on my daily scans and alerts, I'm definitely looking for opportunities in healthcare, because even if the market goes down, with a sector rotation model as a thesis, since we've had energy lead and we've had consumer staples lead, the next sector that should see an overperformance is healthcare. And it just had that big drop. So that's what I'm looking for in relation to the sector rotation model going into this quarter. So hope that helps you guys look for opportunities as well. Now, I've saved the tedious for the last, but this is important. And this is going to be a little explanation on how longer term options work. I'm going to use ExxonMobil as the example. Now, what I tried to do I didn't take a screenshot of it, but in Discord, was back when I took this trade, I wanted to use it as an example because I get so tired of these people and their weekly options. I have not met someone that can consistently make money off weekly options. And throughout my career, I've done successfully longer term options. And what I mean by that is in excess of 60 days to at least 2 months of expiration, because you really start to see that decay in option value in that 45-day range. So when there was an opportunity here on ExxonMobil, there was a couple of things. Number one, again, looking for reversals, it was at this 50% retracement level right here. Okay, this is on December the 2nd. We also had a spike. Now, this spiked down here on that day, and it was at that level. So I have to respond to this. This is the kind of thing that I want to look for. But what I decided to do was take it in options to show people on the Discord and wherever else that this is how you can effectively trade longer term options, not weeklies, but longer term options. And it's important for us to look at one more thing. Now, unfortunately, TradingView doesn't have this data. Let me pull it up. But Thinkorswim does. So, yeah, we can see that down here at the bottom. Let me clean this up. I only want to look at what I want to look at. Yeah. Okay. So December the 2nd is here. Okay. So this is where we took the option long. And what I chose to do was a February normal expiration. What day is that? Let's see. That was the February 18th. Now, why did I choose February 18th? Well, when I took it, the days to expiration, 1 second, let me do the math here. The DTE was 78 days. And I know that's kind of anathema to some weekly options traders that are trading within 2 or 0 day options, but 78 days. Okay. All right. It's okay. It's okay. We can do this. So, and also, if you notice, earnings is going to be on February the 1st. Whenever I'm taking a longer term option, I want it to be at least more than 60 days. But I always want to include the next earnings cycle in there for the reason that stocks move based on earnings. And they don't necessarily move right at earnings. You can't really play that with options because volatility crushes all the options, lose their value after the event's already happened. But the run up to earnings, there's money. That's where you see these big moves within 3 to 4 weeks before earnings. And that's actually, if you think about it, if earnings is on the 1st of February, this move up started happening right at the 1st of January. Now, I know that kind of just fits with the year, but again, 4 weeks before earnings, you've got this run up. You needed to already be in before earnings. Anyway, we got in here on December the 2nd when it pulled back to level and I had a signal. And February 65 calls, that was out of the money. So 65 is the strike price. Basically, how I choose a strike price, I think about what is reasonable for this to get in the money. I don't like at the money. I had this conversation with somebody today. I don't like at the money options because you're really on a knife edge where, yes, you can get, you have a good chance of it expiring in the money, but you also have an equal chance, 50-50, of expiring completely worthless out of the money. Plus, you don't really get paid for taking on that much risk. An out of the money option, you get cheaper, you have a lower probability, but as that thing moves up, as you start getting closer and closer in the money, you start making more and more on it. It just becomes more and more profitable. Your win rate will be less, but your reward risk will be so much more. So I evaluated this trade a few days in on the 7th. See, when it first got back to a first resistance level here on the 7th, let's bring up the thing. So let's say, let's do, is that the 7th? Yeah, the 7th is right here. It first got to a target from here to here. Now, if you were trading weeklies, maybe you could have made some in here. But at this point, because the option was so long-term out, it didn't make very much. I made a spreadsheet, and this is where I say we're going to get tedious, but I want you guys to learn from this, okay? So these are the different dates that I did some evaluations on it. So this is 12/7. This is 5 days into the trade. It was bought for $190, and then when I evaluated again, it was at $218. So you've only made about $28 on this. Not very much. And the point I wanted to make to people is this. This right here is the implied volatility. And this is why I brought up Thinkorswim. Because if you notice down here in this lower part, what these lines, these color lines are, is the implied volatility. The yellow flat line is average implied volatility. By just looking at it, you can see that where I purchased the option, IV was higher than average. And that's not good if you're buying options because that means you're basically overpaying for them. The IV is higher than normal. It's inflated. The market's looking for something. I don't know. I don't know what was going on there. I really don't. Maybe it was the inflation stuff. I don't know. The options on ExxonMobil were overpriced. What I did to offset that, and I'm not really going to talk about, I did a put credit spread to offset that cost. That's the topic for no discussion. I just want to talk about the single option. But knowing that, I wanted to demonstrate what happened. See, on the 7th, if I bought it here with IV high, and then on the 7th, notice implied volatility came back below average. IV crushed. It went down. All the option prices, both calls and puts, in some way they lost value because implied volatility went down. And so this is the key thing right here. This is the IV that when we started the trade. And then on 5 days later, on the 7th, it was down to 30. It went from 33.888 to 30.13. Only 3 points, right? But the Greek Vega, this is when you look at the Greeks on options, the 3 that you want to really concern yourself with are delta, theta, and Vega, and those are the ones that we're going to talk about here. Vega is the amount that your option is going to go up or down. Like here's 0.11. If you have a single option, you can say that's $11 for every point of IV. So for every point of IV, and we have about 3.5 difference, we're going to lose $11 theoretically. So what was the price move? Well, I already did this to be quicker. So let's just bring this over. So the movement in price from the time I bought it, it was 60.39, stock price of XOM, to 5 days later, 62.81. We got a movement in price of $2.42. I sort of, just to make things simple, to give you guys this calculation, I do a little average of the delta between the point that I bought it and the point that I'm evaluating it. So basically, I just take the delta from when I bought it and then the delta of when we're evaluating again on 12/7. And then I come up with the average between a delta of 33 and 39. What delta is the amount the option will move for every dollar move of the stock. So for every dollar that XOM would move, the option price should move $33 from the start. Or because it's getting closer in the money, we want that. Notice how that delta goes up the closer and closer it gets to our in the money. Now it's at $39. So it would make a mathematician that knew the Black-Scholes model wince for me to just do an average, but it's gonna serve our purposes quickly. So the average delta for these $2.42 movement is going to be 36. Okay, so that's going to give us our delta, and then the average Vega, again, Vega changes a little bit from 1.1 from $10 to $11. So let's bring that over here. Basically, it's just going to be 11 too. And so here's what we come up with, and this is where things get really cool. This is where things get really interesting. So our profit, again, here on this first day of evaluation was about $28. That's what our actual P&L showed in our account, plus $28 on this option. Nothing. Basically, our reward risk is just a 15% return on risk. It's nothing. Hypothetically, if we were just looking at the delta movement, the movement of the stock, we should have made $87. But we had it for 5 days. So 5 times $2 a day of theta means that we lose $10 just holding it open. But then that 3-point move, 3.5-point move on Vega cost us about $40. And so hypothetically, we should be up 37. So within that realm. The key thing here is just that 3% move in IV was enough to cut our profits in half. It's pretty significant. And that's what I wanted to illustrate to people when I talked about this on Discord on December the 7th. This is how important it is when you are buying options, longer term especially, to know what your implied volatility is. And one metric that some people use, I use, is either implied volatility rank or percentile. That tells you where it is relative to the past year. So if you have a high IV rank and or a high IV percentile, you need to understand that you're probably going to lose as that implied volatility comes down. You may still win, the trade could still work, but you're putting yourself at a disadvantage. You really want to buy options when IV is low. That's really optimal, but you don't always get that option. So last week, there was a little spike in oil. And being the trader that I am, that always takes profit a little too early, I took off some of my contracts of XOM. Only got close to about a 1 to 1.84. But let's evaluate that data real quick. So this was when, and the other reason from the ExxonMobil perspective was, let's see, where do we get to 1.5? We were basically coming up to here. We basically got that option passed in the money. This is 1.5. This is January the 5th, and we're breaking above it. It's a good target. Okay. Of course, now we can evaluate today, but we'll get there. So at the point that I took off some of my contracts, the price move was a little over $6. Notice how as we get closer in the money, that delta, we started with a delta of just $33. Now for every point in ExxonMobil movement, we're getting $60. We're making more and more the further and further it goes along. This is the advantage of out of the money options. They just get better and better as it goes in your favor. Average Vega went down a little bit, but let's see what happens. Okay, so hypothetically, we should have made about $300 in profit off of just the move of ExxonMobil. We've held it open for 34 days, so we lost about $68 on Theta. And Vega, because we're off by even more, because IV's gone down even more, we've lost about $53. So hypothetically, with all the Greeks, bad mathed into it, we should be up $174. And if you look here, our profit is $160. We're in line with what we should do. This is basically just explaining what these Greeks mean and what they do. Hope you guys are getting that and understanding why it's important to know how much you're losing to Theta and why it's important to know how IV is affecting your profitability as well. So finally, let's look at what it ended up today. And we can just use this right here. So now as of today at the close, it's up. Is this right? Hold on. This may be different. 1 second. 71. Oh, hold on. 71.87. Wait. Oh, it's the same. It's the same number. That option, the 65, is about 730. The delta, again, as we get further and further, delta just keeps getting better and better. And as we get closer to expiration, that's going to get closer to 1. It's going to get even better. This is why I love out of the money options. Theta is about the same. Vega has, is it 0.5 or 0.05? .05. Typo. So this option now, having it on for 43 days, we've lost about $86 to Theta. That's the price we pay. Notice how volatility, as we've started breaking up, volatility is now risen for us. Let's look on the chart. At least on this option. And you know what? You see that? You see this right here? See earnings? Volatility is going to keep going up into earnings too. We're going to start making money on Vega if the IV starts getting back up there. Notice how we're losing less because Vega has moved and the price of the trade is now not hurting us nearly as much. So hypothetically, 580 just based on the Greeks. And of course, now that option, single contract is worth $540 profit. We're getting close to our magical 3-to-1, which before earnings, I think this option contract is going to get. This is how you do long-term options. And why I like it so much more. I don't understand how people can sit there with weekly options that they only win 1 out of every 5 and only take 1-to-1 profits at best. Just stop. This year, I'm going to do more of these because I want to get people away from weekly options. I want you guys to understand that there are these things called normal expirations, and it takes patience. It takes a little bit more money, but not really. I mean, how many people are? I mean, come on, $1.90 for this option. I know people are spending $500, $2,000 on Tesla weekly options. Give me a break. You can afford this. I'm not going to take the excuse that you got to take weekly options because they're cheaper. No, you could have done this with $190 and you could be sitting on this right now. You just needed to be patient for 43 days. Oh no. You're here. Time has passed. You didn't need to make that money that week. Just take a longer term perspective. So hope that helps some people. That's going to be my crusade this year. That's what my pivot is going to be. I'm going to go. And there's some reason to this. There's some method to the madness. 2018, let me clean this up a little bit. 2018, this was that January crash that we had in 2018. And for the remainder of 2018, IV, the VIX, now we're getting back into SPY and the VIX. It remained pretty elevated throughout the entire part of the year. It basically ranged between 20 at the high down to 11. And then in October, you had a much higher range. This is where I made a lot. I basically killed myself in January, treaded water until this came back. And so this is really a trader's market for options where you have an elevated IV around and above 20. Okay. So now where do we sit right now? We are actually sitting in an area where there can be some good options trading because, again, going back to the ExxonMobil example, if IV starts working in your favor, the price of that option continues to go up. That's why I love taking options 3 to 4 weeks before earnings to get that bump in IV. You can see it by looking at a chart of IV. ExxonMobil is not a very good example. Hold on, let's look at Apple. I want to see it nice and clear. I want a curve fit. Where are our earnings? Come on, Apple. Come on, Thinkorswim. What about Phillip Morris? Okay. Tossed at it. Okay, anyway, just take my word for it. IV tends to rise into earnings. So, any last questions? I'll open up for some questions real quick. Get them in. It's 5 o'clock. I got things to do. I got my buddy Zygor I actually want to hang out with if possible tonight. So, if you want to talk to me about the spike indicator, you can direct message me on TradingView or Discord. And make sure to join on my signature, my links to the Discord, social media, because things are going to start changing, get more interesting there this year. So, all right. Thank you all for joining me on Discord, YouTube, and TradingView. Love you guys. See you next week.